Next theme on board here is debt, and again, JJ has some great charts here to express that globally and closer to home in Canada and the United States. And he's also looking at corporate debt and household debt. So we'll start with global debt here, JJ. Take us through this.
Well, for clients who've been around for a while at Davis Ray, we started highlighting private sector debt both in Canada and abroad in the aftermath of the global financial crisis. In the aftermath of the global financial crisis, you'd had an increase in government debt, but it wasn't severe. Now we have a problem with government debt. Basically, we now have global government debt, and it holds for Canada and the US individually, back at levels we haven't seen since the Second World War. We've had a two-stage increase in debt, and the first was the global financial crisis and the deep recession that ensued. In Canada, that required a conservative government under Stephen Harper, opening the spigots and spending money and stimulating the economy. We then had the outside force of COVID-19 hitting. And the experience in the global financial crisis was true for every country, not just Canada, but I'm highlighting it with respect to Canada. In COVID-19, and the most recent run-up reflects the hit from COVID-19, also coming from the outside, which caused governments to have to open up the spigots and start spending again to prevent it from turning into something extremely serious on the downside. So political parties on both sides of the spectrum are responsible, or their actions increase the government debt to GDP ratio to alarming levels. There was not much else they could do about it, and I'm inclined not to cast any blame over it. But the fact of the matter is we have an overhang of government debt. We've seen the same thing in the past. We saw one after World War I, was helped by rapid population growth, and as we'll see in a minute, a burst of inflation. We saw a huge increase in government debt in the aftermath of the Second World War. Rapid population growth in a number of economies, especially the ones benefiting from immigration, grew their way out of it with help from inflation being higher than normal for a period of time, and also help from what is called financial repression, where economic policymakers, particularly central banks, hold interest rates at levels that don't compensate savers and investors for inflation and basically steal their money. And the odds are that we're going to see potentially some combination of that going forward, because based on the demographic projections, the odds of us growing out of the debt problem in Canada, the US, or really any other country is going to be impossible. We're going to have to use one of the other techniques of higher inflation, ultra low interest rates. I think both of them to some extent. We also have to look at government spending and what services governments provide and how much they tax us. And we've had a discussion a number of times. John and I both worked with Michael Wilson at RBC and had a great deal of respect for him. He and Brian Mulroney started a really good tax reform in the late 1980s, reducing income tax rates, creating the goods and services tax. And despite all of its bluster, the Chrétien government, with Paul Martin and then John Manley as finance ministers, also extended that reform. And we ended up in a great situation. So as we look forward, the challenges for all of us as kind of citizens, business people, and investors is going to be, how is this government debt going to be whittled down when we can't grow out of it with population growth? So we're going to need ultra low interest rates for probably an extended period of time. We're going to need some inflation and government services, and higher taxes or a tax reform are on the chopping block. And with the populism we're seeing and listening to the level of discourse coming out of Washington and Ottawa, I'm not encouraged about what's going to happen with government services and with taxes.
JJ, overlay global government debt that you've been discussing with Canadian and U.S. corporate debt and with Canadian and U.S. household debt, and there are some interesting divergences on those charts.
Yes, my big concern for most of the past decade or so has been with global private sector debt, particularly the corporate side of things, where it's increased across a whole range of nations, and it's grown alarmingly so in China. And we see it rising both in Canada and the US. And what we see is that both businesses in a number of nations have used the opportunity of ultra low interest rates to manage their capital structure, i.e. share buybacks and payouts to shareholders financed by increasing use of debt. And we've seen the ratio of debt to GDP, corporate non-financial debt to GDP, increase in a range of economies, both Canada and the US. Both are sitting near historical highs, and that increase is alarmingly high in Canada. When interest rates started to go up in the 2016, 2017 period, we found it didn't take a lot of interest rate increases in either Canada or the US to cause the economy to slow. This increased debt load, particularly on the corporate side, makes these economies more sensitive to interest rate increases, and Canada much more so than the US.
I think, JJ, it's also interesting to note that this is corporate financial debt in Canada, and when you look at the Canadian stock market, there's a couple of areas that are very exposed. You see Rogers is buying Shaw Communications. They're going to strap on $19 billion in debt. Forget about their customer service problems that Rogers has. But, I couldn't help but get that one in. Sorry.
That's your pet bugaboo.
That's my pet bugaboo. But, you've got these businesses, telecommunications, pipelines, and real estate companies, that if we do go through an inflationary spike, or if we do have a technological disruption, let's say, Elon Musk's Starlink business starts cutting into the subscriber growth rates for these major telecommunication companies, and they have a lot of debt, this could be a major, major issue and problem. So that's why we're really focused at Davis Ray on making sure that we're investing in strong businesses that have strong balance sheets, compelling products and services, and not in Canada.
And not to go too far on Rogers, but you don't own them. But didn't they struggle to get their debt out the door recently?
Well, there's concern about Rogers, not only because of the sheer amount of debt that they're taking on, but also corporate governance issues. And investors are sort of wondering what's next. And so, investors, when people lend money to people, they want to make sure they're lending money to people that have a consistent business strategies. And Rogers, as an example, has gone through, 4 CEOs in 10 years. It's pretty disturbing.
Okay, JJ, let's bring it to the consumer now in Canada and the United States. Fascinating divergence here, as I alluded to earlier. So we see here that the U.S. housing bubble bursts around 06, 07, and then there are a lot more savers, unusually, in the U.S. these days compared to Canada, where the debt-to-income ratio remains at a very high level. Canadians have been warned for the longest time, especially when they're borrowing for their houses, but it remains at a very elevated level. What are these charts telling us, or what does this chart tell us?
Well, the chart in Canada has been saying our household sector and all of the businesses that have provided them with credit are getting riskier and riskier going forward. And ultimately, there's going to be some trigger that causes a correction potentially. And that's most likely to be interest rates. It was the Fed raising interest rates above 5% in the lead up to 2006, 2007, that caused the bubble to burst in the US. And the question is will we get that high in Canada? But Canadian households in particular, and Canadian households have a lot more debt that reprices more frequently than American households do, and more than a lot of corporations do who are issuing bonds. Canadian households, most of them have variable rate debt or 5-year debt, and they face some serious risks over the next number of years if interest rates do go up. This is also, in my eyes, a constraint on how high rates can go in Canada. I've met Tiff Macklin a number of times. I think he's a really smart guy. He's a decent guy, and I don't really think he wants to be known through history as the guy who blew up the housing market in Canada. So I think he's going to tread pretty carefully. So central bankers everywhere, but especially our friends in Ottawa at the Bank of Canada, are walking a tightrope. They need to restrain. They argue that they need to get inflation under control. So they're going to raise interest rates, but they can't raise them too much to cause a big fallout or a debt crisis. They want to restrain the economy without causing a crisis. And that's going to be a challenge. And we're going to feel our way forward like blind men and women in the dark, trying to find our way to the exit.